In this video, I want to talk about a very important topic in chart analysis and market structure. This tool will allow you to be good at finding and confirming trends, and good at finding great entry points for trend continuation to exploit the trend for your profit. This tool is called the net worth gap. Net worth bursts are long candles that change the price of an asset dramatically. Such candlesticks often appear in case there are some important news or statistics on the market, or a big player enters the deal. And in this case, you have the market valued at about this level, and suddenly something happens. And we have a sharp upward candle or a sharp downward candle, which breaks the value. Now, fair value is not at these levels, it's at these levels right here. In order to set this indicator correctly, we need to set it on the edges of previous candles. Here we are looking at the end of the previous candle, that's the bottom of this green candle. And also look at the upper point of the next candle. We put that level out, and that's what's called a fair value gap. Often, this fair value gap will become a resistance or support level for the next chart movement. For example, after this value gap, the chart may move upwards. It almost reached the gap level here, but bounced early. But if the chart came up to that level, it would very likely bounce back down. And this is the fair value gap that we can further use as a point to look for bounces. If we were to do this on the top chart, for example, right here we have a little fair value gap. We could also put it out, and further rebound would be exactly from this level. This is an important structural point in analyzing the market, and if you learn how to use it properly going forward, you can greatly improve your trading results. So in this video, I want to talk about how to make sure that you're finding fair value gaps correctly and using them correctly. Why, for example, this fair value gap right here turned out to be valid and correct. And further from it, the chart only went downward. And subsequently, as you can see, the chart never crossed the levels of this gap again anytime soon. And this gap can be labeled as well. That's where the minimum value is. And here's the maximum. There's a fair value gap too, but it didn't work. And in this video, I want to tell you how to differentiate and find the right fair value, where it's just a scam that can lead you to losses in the future. So the first thing we have to consider is the length of the candle. The fair value burst differs in strength. For example, on this chart movement here, we can see that there are quite a few of them. We have one fair value gap, second, third, fourth, four at least gaps. Fair value only on this move. But the longer the candle, the more likely it is that we have had something really important happen in the market and that it will become a future fair value gap. Specifically in this move, I would only take into account this long candle and this long candle right here. These are the small candles that were in the beginning. I would skip, simply because the longer the candle, the stronger the fair value gap signal. The second very important rule we can look at on this same chart plot is the candlestick response to the fair value gap. Here, let's put them both on a graph. 1, 2. And let's label this third one. So what's the difference between a good fair value gap and a bad one? We look at the reaction of the following candles as they come close to breaking. As you can see, as soon as the chart starts to approach the fair value gap, it immediately starts to reverse. It happened once, second, third, fourth time. And especially when a candle comes up and draws a long tail here, it means that the trend has had time to grow to that point, bounce back, and continue down. This means that the chart has met strong resistance and orders that are pushing it down in this area. Same here. As you can see, right here is a candle that has already attempted to break through the fair value gap level. We'll see a bounce. As soon as the chart started to approach it again, bounce again. That means that these fair value gaps are strong. This is where we see the opposite situation. We have a fair value gap, we have a first candle reaction, pretty correct, with a bounce. But next we see a single candle closing inside the gap. This is already a signal that this gap is not valid. We will not make deals from it. If any subsequent candle has already closed inside this range, if the chart has gone beyond this range, as in this case, we simply remove these lines. They will not help us anymore. That's the wrong fair value gap. The next important factor is the coincidence with some previous important values, for example, with resistance support levels. If the fair value gap coincides with the support level. Here, if we draw the previous support level of the chart, let's mark in a different color, so there is no confusion. Here we have the previous support level. The chart has bounced high from it in the past. We have a liquidity zone here, a buy demand zone, and as you can see, it coincides very clearly with the next level. If we have some confirmation from a support or resistance level, it is a good signal. This means that the fair value gap will continue to work well. We're seeing the same thing in this area here. We can draw a resistance level here. You see, in the past, there was a bounce here, another bounce here, then a resistance level was broken. And again, this resistance level started to work, and it matches the fair value gap level pretty closely. This gives us another confirmation that these two are correct. And here, specifically, we can't show anything of the same kind. Then the next rule is the priority rule. You probably already, as experienced traders, realize that a trend, the longer it lasts, the less likely it is to continue in the future. That is, our fall has already been recovered quite strongly, which means that somewhere here, we will face a rebound or possible corrections or possible trend reversals. Therefore, fair value gaps that appear at the beginning of the trend are more important than those that appear near the end of the trend. For example, in this section, on any trend, we have several fair value gaps at once. For example, right here we have it, we can mark it. The first break on this trend. Here's the second, here's the candle, and here's the previous candle. Here, by the way, we have both a retest and a rebound at once. This confirms once again the good fair value gap. But these ones that are near the end of the trend, that's the gap. It's there. And this candle right here could also be considered a breakup. They will already be less valid. As you can see, they ran into rebounds here, and they were not confirmed. Therefore, those value gaps that assign the trend will be more important than those in the second half of the trend in order to be good at determining where the good gap is and where the bad gap is, where prioritized, where not prioritized. We can use a tool like this called a Ghana box and expose it on the edges at the low and high of our trend. Those fair value gaps that will be in the lower half, we ignore them because they are already close to trend decay and they may be more likely to be wrong. And the ones that are in the upper half, as you can see, both of the gaps that I indicated are in the upper half. They are good and they can be used for further trades. These were simple rules on how to use the fair value gap. If you vault this tool well, you will clearly find moments, such as in this case here, when to additionally enter the trend. For example, we have trend started has labeled several fair value gaps. They are at the level of previous resistance supports. They did not overlap with subsequent candles. They have a relatively long body relative to the market. Here, you see the candles are pretty small, but relative to the market, they have a pretty long body, and they are in the early part of the trend. And as you can see, this particular fair value gap has shown us a good signal twice. This is where you could get into a down trade, and this is where you could get into a down trade, and we made a nice profit on the downtrend. Be sure to incorporate this into your trading strategy and use it for your trading. Fair value gap is a structural part of the chart. It is part of price action, which means that we can use it together with other indicators on any time frame and any asset. The rules of the market work everywhere, and you can apply these useful rules everywhere